The following is an update and technical analysis on the US yield curve, followed by the 2-year, 5, 10-year, and 30-year long end of the curve based upon the daily interval, where before I'd like to go over two trades that I had initiated and am currently within the process of scaling it out by implementing a single-digit stop-loss strategy, starting off with Bitcoin, trading amongst big resistance off the 37,890 major reactionary high price resistance, where we had that undercut, had a really consolidation phase, hugging amongst that key inflection point. We finally took it out, had a follow continuation of the 240-minute interval candle close there, and additionally taking out the 38,389 price resistance up above. Call it minor price resistance, where we ended up backtesting off that key inflection point, and it is off to the races in a scale in and out process of these short trade setups. And really what was a lot more significant from any juncture in this critical standpoint was the hidden positive divergence that has been put into place effectively right off of three technical key momentum indicators, including the stochastics 1033, and that is a very bullish sign, with the moving average convergence now completely overtaking and recovering the zero line threshold with a bullish crossover up in that key inflection point. Stochastics above the 85 threshold, very healthy looking sign, based upon a 3 outside method on the daily interval. And this is a new primary reactionary parabolic uptrend line that I've added with additional reactionary lows really across the board there. And that could be the next spell for a complete backfill of the gap, 53,000, if and when we go on to test that key inflection point. Bulls traders, long traders, they want to defend this parabolic uptrend line really at all costs to avert any further selling on a prolonged move, re-challenging some other multi-price resistance levels based upon the weekly and or long-term all-time high resistance levels that are really baked into on the 2021-2022 era. And if and when we come across any of those junctures, I will come back to reassess a potential short trade setup on Bitcoin. As for now, the ball is in the bull side on the bullish trade on a prolonged move to the upside, especially if you took the breakout. If you took the breakout right amongst the 37,890 price resistance and the 240.50 moving average, you set some stops below, and that was just transpired into a big move to the upside if and when we're bullish on Bitcoin for a prolonged move up for 4.2% and beyond. But again, I'm waiting for a snap and or a crack below some of these key levels and reflection points, and really, which was the bigger primary reactionary uptrend line with major reactionary lows, is the big key inflection point that I am going to continue to watch if and when we start to break down, take some of these key levels out, and remain keeping these negative and bearish divergences, massive divergences intact, especially if we go on to retest, put in an additional marginal new high, only extending a much larger big divergent high, and that could be a potential catalyst to keep these negative and bearish divergences intact if and when we come across that juncture. As for now, it is time to scale out and wait for the next, being exceedingly patient in the next trade setup. Taking you out to Williams Sonoma based upon the 60-minute interval, and the big 188.18 price resistance has been taken out, where we did have an additional reaction right amongst the 60-minute candle closes. And this was your first reaction. It looked like it was going to start to trend down here, ended up having a false rejection, another rejection, multiple hourly prolonged assessment of reactionary highs that were being rejected pretty impulsively there. And that's how you know that level was so psychological, when you have a green candle close of this magnitude to the upside, only initialing an additional major breakthrough and a complete breakout out of resistance. That was the prolonged setup. And again, the scaling out process, getting out of this trade for stop loss, for single digit stop loss versus the 10%, 20% double digit crashes, for a great risk reward ratio to the downside, 4-to-1, 5-to-1, depending on how you're structuring your trade idea. But again, just look at the infused green candle closes, just again, completely validating how psychological this level and true resistance level was. Deep diving into the US 2-year off the daily interval, and we have completely taken out this primary big reactionary uptrend line off the 2022 May reactionary lows, and that has been additionally taken out. I had mentioned this additional minor reactionary uptrend line that needed to be defended heavily by long traders and or bull traders, really at all cost, with a breakdown sell signal that was initiated on a complete beautiful back test, especially if you're following these key inflection points, correlate and confluence of the 509 price resistance, called a duo transitioning line of resistance there, and that was good for a 10.5% crash to the downside in that yield. And here we are taking out the 236 fibs retracement, call it 464 price support, and that had major reactionary highs and lows, call it multi-year price resistance and support, and that has officially been taken out with a solid red candle close below the 463 236 fibs retracement, with initial reactionary lows At first only setting up a dead cat bounce for a big rejection move to the downside, ultimately undercutting the 200 exponential moving average, where support now becomes resistance. And bear traders of the 2-year yield want to see a prolonged move down to 426 price support. Taking you to the 5-year, and here we are once again, dip diving in a complete momentum fueled overshoot right back into this trading range, where we broke out of this additional big major reactionary high primary top of the trading range, took that level out, completely took off, back tested with major reactionary lows for nearly an entire week here, and then ultimately finally taking it out, back testing it once again, keeping steady above the 4,375 price support, only to come across with a nice steep counter trend rally, only to close once again right back below that key inflection point. And here we are, undercutting the 200 exponential moving average on a prolonged potential move down to 4,037 price support, especially off this beautiful bearish rising wedge pattern. We had that huge divergent high with negative and bearish divergences really constructed on all 4 technical momentum indicators. We snapped that key inflection point, put in that hard sell signal right off of that minor uptrend line, and it has been off to the races. Never looked back there, and that was good for, call it a 13.3% crash to the downside. Taking you out to the US 10-year, big benefit of a doubt, primary reactionary uptrend line. This was major 2000 multi 3-year price support level based upon the COVID crash lows, and that was a major inflection point. I couldn't hype up as much as I could. Big divergent high with near-term divergences. Had beautiful all 3 technical momentum indicators, huge divergences that had just continued to establish and construct going back since September of 2022, and those were exceedingly large, only creating that big drop, putting that sell signal, back tested once again, back tested one last time there, and was off to the races, really to the button, especially if you're an active trader. That move down to the 420.08 price support was good for 10.5% crash to the downside in the US 10-year yield. As of now, the US 10-year offers a great risk-reward ratio short trade setup, short the 10-year bond, for any short sellers to step in really at all costs to on a prolonged setup. Short sellers, bear traders, they need to defend the 420 price support really at all costs to avert a further drop in a big bidding of bonds to the upside. If this key inflection point gets taken out, it was major price support level. I'll call it multi-year key inflection point that needs to be defended heavily by any short sellers of the 10-year. So a great inflection point for a short trade setup on the 10-year to infuse a yield spike to the move to the upside. Taking you to the US 30-year, big major inflection point off the 786 Fibs retracement. Call it 438 price support, and here we are hovering right up above it. And a major key inflection point, again, giving the great risk-reward ratio on the short trade setup of the 30-year, potentially infusing a 30-year yield spike if and when short sellers end up stepping in there, whereas long traders, they want to see a breakdown and a continuation of this breakdown in the 30-year bond down to the primary reactionary uptrend line off the April reactionary lows of 2023. And that is a major key inflection point if and when we go on to retest that key inflection point. So I believe the yields are coming to an inflection point where they could increase the odds of a potential bounce and a rise in the entire yield curve. When you consider how extreme this breakdown sell signal was, backtesting the primary uptrend line really to the button there, offering a great long trade, short trade setup of the 30-year yield down for a 9.2% crash to the downside. But again, as far as the 30-year and especially the 10-year, I believe the 10-year and the 30-year, more so the belly and long end of the curve, offer a great short risk-reward short trade setup to the downside in bonds.